Welcome, everyone. Good morning. Welcome to Daily Rates Live with the Mortgage Calculator. We'll go ahead and wait just a couple of minutes. We'll put the chat up. Go ahead and drop a comment there in the chat while you tune in. And we'll wait just a couple of minutes here to get live on all the different platforms and give everybody a chance to tune in. But thank you, everyone, for tuning in nice and early. Good morning, Taryn. Good morning, everybody there in the comments. Jonathan, Samantha. Good morning, everyone. It's Monday, time to get back to it. Let's all have a great week here. All right, good morning, Jason, Amanda, everybody tuning in there in the chat. Pearl, Amanda, Matthew, buenos dias. Good morning, everyone. All right, it looks like we are live on all of the different platforms, so we can go ahead and get it started here. We'll take off the chat and we can get into it. So welcome, everyone. My name is Kyle Hiersche. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hiersche, and our sales manager, Jose Gonzalez. We are a non-correspondent, non-delegated correspondent lender that specializes in non-QM loans. What we do every day here on Daily Mortgage Rates Live is pull up a different quotes for all of the rates for today, actual live rates, and then we do a deep dive into a different topic every morning. Now, today's topic is asset utilization loans, which is something we're very familiar with here because we do specialize in non-QM loans here at the Mortgage Calculator. So what we'll do is in a little bit, we'll have Jose pull up some actual quotes for asset utilization and do a deep dive into that topic. But before we do that, just like we do every morning, we'll go ahead and pull up our pricing tool and we will go over the actual live mortgage rates for today. So Nick, why don't you pull up the pricing tool here and we will go through the rates.
All right, thank you, sir. Let me go ahead and switch my screens and we'll get started. So, as Kyle mentioned, this is our pricing tool for our team of mortgage professionals. We have over 300 licensed loan officers, and we're licensed in 22 states for primary second homes. And we can do our DSCR business purpose loans, which we love to do, in 44 different states. So if you'd like a full loan estimate, please get with one of our team members. They'll break down all the costs. This tool will show us the general rates for our programs and the APRs, including all the costs. But if you want a full breakdown, please get with one of our team members for a full loan estimate. Now, what we'll do for today, as we do every morning, we'll set up a basic scenario of a $400,000 loan amount. We'll set the LTV to 80% loan, 20% down payment. We'll tell the computer to find the best rates at 99 price. That means one discount point in cost, which is usually the request right now for most of our customers are asking to buy down the rate a little bit since the rates are a little higher than most people would like. Now we're going to compare our three options here every morning, our conforming conventional options to our FHA options, and then we'll check out our expanded guidelines, aka non-QM, where we have over 5,000 additional programs that can use alternative income documentation. We don't do the VA rates live. That's only for our eligible vets. If you are eligible, we appreciate your service. We'd be happy to quote it, but since not everybody is, we won't do that live. Same with USDA. That is only for eligible property in a USDA eligible area, in a rural area. If you do happen to be shopping there, please let us know. We can quote that pretty quickly. But let's start with our conforming conventional example. We're going to set everything today to a purchase, 30-year fixed, pretty standard loan. For these first examples, primary occupancy, single family home, 1 unit, state of Florida, county of Miami-Dade. And for all of our demos today, we'll use an estimated FICO score of 760 and an estimated debt to income ratio of 40%. So with these general settings, let's check out our conventional rates today. About the same as it was last week. Not much movement here. Looks like the best option the computer found, 6.49 rate, one discount point in cost, and a final APR of 6.666. Remember to use the APR to compare our per us programs so that we can compare our conventional to our FHA and then our non-QM as well. So that is the rates for today, right about the same as it was last week. So hopefully we see some downward movement later in the week. But let's check out the FHA as our second example. We'll keep everything else exactly the same, 80% loan to value. And we'll simply click over to FHA here so we can compare our FHA rates this morning. So you obviously see a much lower rate here, but remember we're keying in on APR, always comparing programs. So best option the computer found, 5.625 rate for 0.875 discount points and costs, and a final APR of 6.223. So in this example, FHA is a little bit cheaper, even considering that FHA has an upfront funding fee and or mortgage insurance and a yearly mortgage insurance. So those changes have worked in our favor. So in this scenario, this price is actually a little bit cheaper than conventional. And FHA does allow a little more leniency on the credit and DTI. But now if our customer for any reason doesn't qualify for conventional or FHA, many other banks or lenders don't have other options. But that's where we love to come in with our expanded guidelines, aka non-QM programs, for the same exact scenario we just went through. If for any reason our customer doesn't qualify using their full doc here under income verification, let me scroll down. Full doc is 2 years of tax returns. That's what we would use for conventional or FHA. So we would typically choose an expanded guideline program that would allow us to use alternative income documentation. So we have 1 year alt doc, 2 year alt doc, asset related programs. So Jose's going to go into detail on that here in a minute. We have business bank statement programs, our investor DSCR programs, bank statement for personal bank statements, 1099, P&L, all these different options. Most popular option for a primary home purchase would be our personal bank statement 12-month program for our self-employed borrowers. Many times our self-employed borrowers, when they're applying with 2 years of tax returns, have various write-offs and may not qualify for the income that they wish or qualify at all. So in this case, we're going to actually use 12 months of the bank statements, the last 12 bank statements, to determine a debt to income ratio using the actual cash in the bank statement. So a much different way to calculate income. Typically, our self-employed borrowers can qualify with much more income and therefore the house that they wish to get. So let's check out our rates this morning. Non-QM is going to be a little bit higher rates, but again, this is for a customer who needs alternative option to get the house that they want. So a little bit higher rates here. Best option at the top, 7.00 rate for 1 discount point in cost and a final APR of 7.080. So remember, conventional was 6.6 something. Remember the FHA was 6.2 something. And now our non-QM for the same exact scenario allows us to go to just over 7. So very comparable. We love when these options are all very much alike. Please get with our team to find which one might fit best for you. Now, when we're in the non-QM world, you can see if we scroll down, there's dozens, if not hundreds of different options within the bank statement realm. So we have different options that may allow things like credit events, like a foreclosure, bankruptcy, things like that. So please get with our team. There's tons of different options in the bank statement world here and the non-QM world in general. Now, before we go into Jose's deep dive example into one version of non-QM, we always want to check out our investment property rates. So for our last 2 live pricing demos, we will set up the same scenario, 80% loan to value, 20% down, this time for investment property. And we're going to compare our conforming rates for conventional rates for investment property to our expanded guidelines, aka non-QM, for an investment property. Remember, FHA, VA, USDA are not eligible for investments. So we'll start with conforming, everything else the same as all our other demos. Now let's check out investment property rates for conventional. So we see here some decent rate options, but as we say every morning, there's a high cost here. So the GSEs, the entities that do conventional loans, have added additional costs for investment property. So while we see a great rate option here, 6.875, very comparable, the discount points are high, 2.875. The final APR here for an investment property under conventional, the best option, 7.114 APR, which is a great option for our borrowers that qualify conventional. Many times, our investors would like another option to go higher in rate for lower discount points. In this example here, $11,500 is a lot of money out of pocket, right? So even if we go down the list and try to find a little bit higher rate, if our investor wants not that many options here. So looks like the best one here, 7.5 for 2.5 discount points. So many times our investors would like other options, and that's where we love to present our non-QM. So for our final demo today, we'll go back to our pricer. And we'll do the same 80% investment property. And this time we'll select expanded guidelines, non-QM. And we have 2 new options to fill here. So as before, the first option is income verification. So what type of non-QM alternative income are we going to use? And the most popular option by far for investment properties going to be our DSCR option. And that's because it actually doesn't require any income or employment from the borrower. We're just going to use the estimated rental income from the property to determine a DSCR ratio. If the estimated rental income covers the expenses, the PITIA of this mortgage, the ratio will be 1.00, aka the rents cover the cost. If the ratio is lower than that, aka the rents don't quite cover the cost of this loan, we still have options for a DSCR under 1. Most of the options allow for a DSCR value over 1. But for this demo, so we can see the most options, we won't even select one. We'll check out all the different combos that we have. Now for a non-QM investment property, we always have a prepayment penalty standard. So we always price it with 3 years. That's pretty standard. If we do need to choose 0, we can. That will cost a little bit more money and limit our loan programs. Same thing with 5-year. That will cost less. Great option for our borrowers looking to hold properties for a long time, but will limit our loan programs. So we always choose 3-year for the standard so we can see the most options here in our demo. So let's check out our DSCR rates this morning. So we love when these options are very comparable to the conventional you saw there. So the best option the computer found, lowest APR, 7.5 rate, still a decent rate, very comparable there, for 0.975 discount points. So our investors' goal of less discount points out of pocket, more cash for other investments is attained. And the APR is very comparable, 7.580. Remember the APR, the best APR for conventional was just over 7. So very comparable programs here. No income needed, no employment needed. We can start 2, 5, 10 loans for our investors to refinance properties, purchase more properties with these DSCR loans for investment properties. So very cool programs. There's tons of different options if you scroll down here with different DSCR ratios, different options of how to calculate the DSCR, different prepayment options. So please get with our team. There's hundreds of different versions within the DSCR. Some might allow short-term rental income, which we love to talk about, and various other flexibilities. So please get with our team. We'd be happy to quote all these for you. Now, before I pass it over to Jose, let me just introduce the topic for those of you that just joined us. Let me switch my screen one more time. And the topic for today, as I briefly touched on, is going to be asset utilization loans. So you notice when we went through the non-QM, one of the options we have is asset related. So there's a few different ways to do this. I'm sure Jose is going to talk about the different ways to calculate. There's a myriad of ways to calculate asset utilization, but these are great programs because they don't actually require any employment. We're simply going to use a large asset account and utilize that to determine if that asset account is exercised or some way we need to dip into it to make mortgage payments. How many or how much mortgage payments can we afford from a large asset account? Bunch of different ways to come from that, but that's essentially what this category is. Someone with a large amount of assets can use those to pay mortgage payments in theory. So, Jose, if you're ready, I'll go ahead and let you take it over and explain the details.
Yes, sir. Good morning, everybody. Thank you for joining us for Daily Rates Live with the Mortgage Calculator. Today's topic is a very interesting one, asset utilization, or also known as asset depletion, depending on whose option you're using, as we have many different options for this type of program. The main thing to note with this program is that we're talking about liquid assets. We're not talking about gold bullion sitting in a bank. We're not talking about fancy artwork sitting in a vault somewhere. We're talking about checking accounts, savings accounts, money markets, stocks, bonds. We're even talking about 401k retirement accounts, which aren't, as liquid as a money market account, but they do have certain terms and conditions under which you can draw money from one of those accounts. So any account that can be liquidated for funds is an account that can be used for asset depletion or asset utilization. Now, I would refer you to the guidelines of whichever program you are considering for the actual formula for the calculations, because they all do vary. Some use 240 months, some use 84 months, and then they divide by different factors. So please do refer to the guidelines for these specific formulas. But the main thing to note is that it has to be liquid assets, stuff that can be liquidated. So in our first example here, I am using a 15% down primary 1 unit asset utilization program. 15% down is the lowest amount of down payment for this program. You do note that our other alternative document programs like bank statements and profit and loss do allow for a little bit lower down payment of 10% down, because in those loans you're actually looking at income. In this option, we are determining income based on a calculation of assets. So a little bit of a riskier program, hence a little bit lower LTV. However, the rates are very good. We're looking here on a 1 unit, mind you, on these examples, 8.75% is the lowest cost option, and you can buy it down all the way to 8%. And that is just a little bit over 2 points on that loan. And the 8.75, I believe, is that's 0.125, 1/8 of a point for that rate. So this is 15% down, which is the highest LTV, 15%
And no
down.
mortgage
And
insurance on
correct.
that, correct, buddy?
Correct. No MI ever applicable on any non-QN deal. So this is 85% LTV, 15% down. So to give you a little bit more context here, now this is 20% down. This is a more usual scenario. The 15% down was, the extreme option there. But now at 20% down, I guess you could consider it more of the standard option for the asset depletion or asset utilization. You're looking at 8.125% at par, no points on that one. And you can buy it down to 7%, and that should be at about 2.5 points on that one. And this is 20% down. And just so you could put it in context here, this was the 15% down option. You'll notice 8.75 and 8%. And then this is a 20% down option, considerably better rates, 8.125, and you can buy it down all the way down to 7%. So at this point, it would be good to consider, is the additional expense worth the extra LTV that you're going to get here for your borrowers? And you do have a good option at 8.75 at almost par. So in this case, it does look like it could be a good setup for your borrower. So now we have our investment option. The lowest down payment for an investment option of asset utilization is 20% down. But you are getting very good rates here at 20% down for an investment. These are almost as good as the rates that you see here for a primary, where 8.125 was par. Over here, we're looking at 8.25 given a $500 lender credit, and 8.125 actually only costing $500 in points. But again, we're looking at 80% here. Now on our asset utilization, let's give you some cash out examples. The highest loan to value for a primary 1 unit cash out using asset utilization is 80%. And we do have here 8.875 is giving us a $500 lender credit. That is our lowest cost option. And 7.625 is costing us 2.5 points. In our asset utilization investment, again, for a 1 unit, you're looking at 75% LTV as the maximum LTV for asset utilization 1 unit investment cash out. And you have really good rates here, 9.125 being your lowest cost option and 8.25 being your lowest rate option. And then, since we do love those 4 unit properties, I did want to show you here that on an asset utilization primary 4 unit, the maximum LTV is 80%. And you do get very good rates here. You're looking at 8.875, giving you a $500 lender credit, and 7.625 is costing you 2.5 points. So I wanted to throw that 4 unit in there because we do love those 4 unit house hacks. So for those of you looking at those 4 units, asset depletion is possible on a 4 unit with 20% down.
All right. I don't see that we have any questions to go over.
We'll go over the calculations in one of our loan officer trainings. So for those of you looking into more detail into asset depletion programs and stuff, we'll do that on our Tuesday and Wednesday night live trainings for those of you wanting to tune in. But thank you, Jose, for those quotes. Those were great options. Lots of cool options there on the asset utilization. So no employment required, no actual income required besides the liquid assets. Great options. Thank you, sir.
All right. Thank you, Jose. Yeah. So as I said earlier, this is something that we specialize in, right? Non-QM. We have over 300 loan officers all across the country, licensed in 22 states for primary homes and secondary homes, and then we can do, our investment products like our DSCR loans that Nick went over in about 44 states. So get with one of our loan officers. They can walk you through these different programs. As Nick was saying earlier, hundreds of different programs, even for just asset utilization. All of them have different guidelines and different parameters. So if you want to get a quote or have a loan officer walk you through your different options here, you can go to themortgagecalculator.com and we can pair you up with one of our loan officers. You could also email us at info@themortgagecalculator.com. So we do this show every single weekday at 11 a.m. Eastern, where we do the live rates and then do a deep dive into a different topic every single weekday. So we hope to see you all on the next one. As Nick said, tomorrow and Wednesday, we'll go a little bit deeper into the asset utilization, which we do on Tuesdays and Wednesdays at 7 p.m. Eastern for our loan officer trainings. But thank you, Nick. Thank you, Jose. Great products here. Thank you, everybody, for tuning in. And we hope to see you all tomorrow at 11 a.m. Eastern time. Everybody,
Thanks,
take
everybody.
care.